So let's get started. So if we're looking at an annual report, you can expect to encounter great quantity of information from financials, notes to the financial statements, which are very important. Our auditor's report, we're going to talk about that, and we're going to talk about auditor's opinions. A 5-year summary of key financial data, management discussion and analysis of operations, which is something that's relatively new, where initially the auditors come in, okay, and they look at all the prior results, and then they go ahead and give an opinion on if you are doing exactly what you say you're going to do based on your company policies, your SOPs, and so on. So that's telling what's happened. But if you're moving forward, the auditors are going to say, okay, so you're going to make this, you have this new project coming next year, and you're going to have to lay out $5 million to get the project going. How are you going to finance that? Or, you have a union contract coming up this year. Do you believe there's going to be any possibility of a strike? So things that are coming up are the things that the auditors would discuss with management moving forward, which is a good thing because, you don't know if you're going to be with some company, you want to make sure they're going to be around. And then as well as material that is included in the report at the imagination and discretion of management. Now that's something I can't help you with, but hopefully as we go through here that you'll have a better understanding and it all makes sense to you. So how do we navigate through all the vast amount of information available to financial statement users? Well, what we're going to do is a little background on the accounting rulemaking environment. I think that's necessary for you to really understand the whole process. So, financial statements are prepared according to generally accepted accounting principles, or also known, if you heard around the office when they talk about GAAP. But those have been adopted in order to achieve a presentation of financial information that is understandable by as is relevant and reliable for decision making. So look, anything in life, if you're playing a game, if you're, competing in anything, you have to have the rules laid out because people will always find a way to twist them or interpret them. So this is what their goal is, so that everybody's comparing apples to apples. So the SEC regulates U.S. companies that issue securities to the public and requires issuance of a prospectus for any new security filing. The SEC also requires filings of. So if you're a company that's publicly traded, you are required to file an annual report each year, a 10-K. You are also required to file quarterly reports, and those are called 10-Q. And again, those reports are all on a standard format, so no matter which one you get, okay, all the background will be the same, just the numbers will be different. The other thing that you need to do is you need to report to the SEC if you change auditors. And if you do, that would require an 8-K. Now, I'm always a little leery of why a company would change auditors. If you have a relationship with them and you're doing well and they're, you have a good relationship, I'm not 100% sure why you change. Maybe, again, maybe you're not happy with them or, you think they're getting too costly. But I also think that what happens if they're not giving you the opinion you want because you want to do some things your way and they're really not the way they should be and the auditors tell you that, you may go to another set of auditors who may look at it differently and allow those things to happen. So just be leery if you do see that someone has filed an 8-K. So who regulates the SEC? The SEC has congressional authority to set the accounting policies. and they've issued rulings called Accounting Series Releases, or ASRs, and Financial Reporting Rules, FRRs. For the most part, however, accounting rulemaking has been delegated to the Financial Accounting Standards Board, the FASB. Now, this is kind of unusual. This board is comprised of 7 full-time paid members. The board issues statements of financial accounting standards and interpretations, usually after some lengthy process of deliberations. So let's say a ruling comes out. And in life, we always have people that look for loopholes, try to go around the system. So maybe a ruling came out and they didn't think of everything, and people are, getting around the ruling. Well, that would come back to this board, and they would have to look into this and see if they could change the ruling a little bit and avoid the people breaking the rules. It's kind of an interesting job. Not sure I would want it, but kind of interesting. The SEC and FASB work together to develop an accounting policy, with the SEC playing mainly a supporting role. All right, so that's just a little bit about the history and what happens. Now, the SEC has congressional authority to set the accounting policies. Oh, did this one skip twice? I'm not sure why that happened. I apologize. Let's see why this screen got bigger. Okay, so why so much emphasis on SEC? Excuse me. Over the past 15 years, corporate scandals such as Enron and WorldCom have brought to the forefront the challenges and pressures that the FASB faces when creating accounting rules. A lot of focus has been put on the accounting firms as how they now have to be careful of conflict of interest analysts and politicians. So when you go back, this was like 2000, and maybe for some of you people new to the working world, you may not remember this. Enron was a big oil and power company in Texas, and they were just doing gangbusters. The problem is they had an accounting firm called Arthur Andersen who did their accounting and auditing, but was also their paid consultants. Well, at the end of the day, Enron basically was not doing well, and they were trying to float money between all their divisions, and they were covering up how bad they were doing. Unfortunately, they went bankrupt, and the part that was really bad that I always remember were all the people that worked there, and there were thousands, and basically they all lost their 401ks. People who worked 20, 30 years for this, and it was all gone. WorldCom, you might have heard of, was also known as MCI. And basically, they were taking expenses of setting up vendors and turning that into capital setup. So instead of showing them as expenses, they were showing them as revenue, which eventually caught on, and that's what did them in. So this is why, now things have gotten so much tighter than they were 15, 20 years ago. So what we want to do is find out, where are we going to find financial information? Corporate financial statements are available from several sources. All publicly held companies must file that 10-K annually with the SEC. The information in this document is mandated by the SEC and contains uniform content presented in the same order for all filing companies. As I mentioned earlier, no matter what report you pull, everything's going to look the same. Documents filed with the SEC can usually be accessed through the Electronic Data Gathering, Analysis, and Retrieval database at the SEC website called EDGAR. And in front of you, I put the website so you could go there. Now, years ago, in the 2000s, it used to cost $600 a year to go there. However, now it's actually free. Now, why am I having a problem with this? All right, so when you get there, this is the screen you're going to see. And you put your company up here and see what you need to get. And then it will take you here. So, if you're doing it correctly, you'll know that you're right if you see these screens. All right, so that was a little bit about the history. Now we're going to get right into the teeth of it. There are basically 4 statements that you're going to look at. I believe 3 of them are integral in understanding the business, and one of them basically ties things together, so I don't think it's all that important. First thing we're going to talk about is the balance sheet. The balance sheet shows the financial position, assets, liability, and stockholders' equity of a firm on a particular date, such as the end of a quarter or a year. Now again, if you all remember the accounting equation, A equals L plus OE, that's what you're going to find. And the reason they use a particular date, so think about your cash account, whether it's your corporate or your personal. On the last day of each month, you're going to get your statement. So let's say it's October 31st. Your balance sheet's going to have an amount that's going to be in there. And, of course, your bank has an amount, and that's what it's reconciled to. But it's reconciled on a particular date. So that's why the balance sheet is the way that it is, so that there are things you can tie together, like the bank account and the cash account. So remember, this is of a particular date. Now, the next one that's probably the most popular is the income statement. This shows you the results of operations, revenues, expenses, and you're either going to have a net profit or loss for an accounting period. Now, when your president, CFO comes to town, and maybe you have your town hall meetings, and they present the results for a quarter or a year, I'm going to guess that 90% of these people are going to tell you how much sales went up, you know, compared to the last year, quarter over quarter, or compared to the industry. And they're also going to tell you the amount of money that they made, again, either in the quarter or the year. Now, nowhere in there will you hear them talk about cash, how much cash was generated. And the ironic thing is you could be a company that is experiencing growth and making money. However, if you are not generating cash, you will go bankrupt. So for me, as important as those two are, the other one that I find that is extremely important is a statement of cash flows. This provides information about the inflows and outflows from operating, financing, and investing activities during an accounting period. So this statement has 3 parts. And what we're going to learn is the pieces that go into each part. Now, the most important piece of this cash flow statement is how much money, preferably a positive result, how much cash did you generate from operating your business? Because if you can continue to operate cash, it will allow you to buy new raw materials, move forward, and move ahead without borrowing money. Because we all know that if we're borrowing, we need to then pay interest, and that's taking away from our bottom line. So I think that that is just as important as the income statement. Now, the last one they have on here is the statement of stockholders' equity. It reconciles the beginning and ending balances of all the accounts that appear in the stockholders' equity section of the balance sheet. So basically it's got the last retained earnings amount, and if you made profit, it'll show the net income, and it'll tie out to the new retained earnings account, which you will go up to your balance sheet, because remember, A equals L plus OE, and you're going to go up to the balance sheet, tie the retained earnings account out, and then you're going to look at the amount of income that shows on the statement of stockholders' equity, and whether it was a positive or negative, you're going to tie that back to the income statement. But as I said, that's more of a reconciling item. It's not really a statement that I would help determine how well a company's doing. All right, so here's what I did. I put together this company, and this was truly an actual Canadian company that is no longer in business, and I just put it under Ron Sporting Goods, and I put something together about the company, which you'll see later on. Okay, so these are real numbers in Canadian dollars. So one of the first things is we're going to look at the balance sheet first. And notice here how it says, as at. Okay, generally they say as of October 31st. So this is their fiscal year end, okay? Now the other thing you'll see is that up here where it has this, what that means is when you look at these numbers, instead of spending more money on ink, there's actually 3 zeros after most of these numbers. But they're going to save the space and the ink, and they're just going to let you know that whatever number you see is really 3 more zeros after it. So let's look at 2009 and compare it to 10, because generally what you're doing is comparing year to year. Because if you just had 1 year in front of you, it would not show you a lot. So what I'm going to do is we're going to go through, but we're also going to put in and note the differences to find out if anything's going on with this company from 2009 to 2010. So this company had $11 million in cash. Now they have $18 million. Having cash is a good thing. We really don't know why, but again, more cash is good. Now, we see that the receivables have gone up, which again, you would think that's a good thing because sales probably have increased and they have more receivables out there. Now, what's interesting to me is, too, their inventory went up. Now, having a lot of inventory is not a good thing, all right? Basically, it means you're not selling it. And if you're not selling this, all right, you're going to have to reduce the price to get rid of it possibly. And then, of course, that hurts all your margins. Now, one of the things we're going to talk about is called common sizing. And what that means is, if I said to you, which percentage is higher? The amount of going from 15 million to 17 million, okay, or 7.9 to 8.8. Well, what you're going to have to figure out is what percentage of that number is it. So when you're looking at a balance sheet, you're taking the total assets and you're putting this number over the total asset number. So, for example, and we'll kind of do this, let's use the 15 million. 15 million, and by the way, inventory is generally the largest asset you will see on current assets on most balance sheets. So here, we're going to say that this number is 15 out of 57. Well, it is almost, if it was 40%, okay, you'd figure this was 60 million. This is 57, so it's a pretty good piece, okay? Now, what is 17 compared to 70? Is that better than 15 to 57? So what you're going to do is you're going to put the percentage over here of what it is as a percentage to this number. And that way you can see each year, just because it went up, this percentage of 8.8 could be a lower percentage to 70 than 7.9 is to 57, okay? But once you do that, you'll see how it falls out, okay? So going back, We saw the sporting goods store had more receivables, more inventory, and then they had more prepaid expenses, which is, a little bit unusual. Actually, those doubled. So right off, I'm beginning to wonder if they opened another store because they have more sales, okay? Their inventory went up. And again, they'll say, well, it went up $1.8 million. Is that a lot? Well, you put the $1.8 million that it went up over the 15. You always do it on your base year. I know in the classes I've taught, people were a little confused about that. It's like if you're making $20 an hour and you get a 5% raise, okay, you put the 5% obviously on the 20 to get to 21. If you backed it off and said, well, how much was your raise? You're taking the difference of $1 and dividing that by 20, and you'd find out that it was a 5% raise. It's the same thing here. All right, so those are the things we've noticed. Future income tax, not a big deal, $109.97. Related party promissory notes, okay? These are assets, so people are giving them money. They knocked it down. All right, that's a good thing. So we see their current assets here were $37 million, and then they went to $48 million. And again, how big of an increase is that? Well, again, until we common size, we really don't know. So that's something that we can look at and figure out. So if we look down here, these are current assets, by the way. And current means everything that is due within 1 year, 365 days. So the accounts receivable should be all paid within that time. The inventory they want to turn over, everything within the year. Okay, same thing when we look at the current liabilities. That's everything that they want to pay, obviously sooner than that, but in the year. Now, when we don't do current, we now go down to property, plant, and equipment, and that is going to be a lot longer than a year. So if we look at this, and again, the tricky part is, I said this is a sporting goods store. The only really property is land, and by the way, land is never depreciable. So if you buy it for $1 million, it'll be on your balance sheet forever at that. Now there's equipment and leasehold improvements. So if we turn this around to be a sporting goods store, the only thing they're really going to have in there are going to be cash registers, counters, shelves, and racks. Okay? But if you look at that, they had $2.8 million in 2009, and it literally almost doubled. So now I'm wondering, well, you can only fit so much in X amount of stores. So again, looking at this, my belief is that Ron's Sporting Goods must have gotten more stores, okay? Because you wouldn't have more equipment, more inventory, and a higher receivables. Now, you've got intangible assets, things like trademarks, copyrights, and those are all amortized. So if in 2009 they had the $5 million or the $9.5 million, it gets amortized, and so it drops every year, and the value is down to $8.9 million. Then there's goodwill. And the best way I think to describe goodwill is, let's say you buy a McDonald's, and you're buying the McDonald's for $1 million. That's kind of what the store's worth. But when you get the invoice and you make the deal, they're going to charge you $1.2 million. Well, I don't know how many of you have children, but I know when my children were younger, I swear they could see the Golden Arches from 5 miles away. So everybody is associated the Golden Arches with McDonald's. So when you buy a McDonald's, it's not like you're buying a local hamburger place where you've got to get ads and coupons. You have those Golden Arches, and those are worth money. So what they're going to have on there is, in the example that I used, that $200,000 is goodwill that you're getting for having those arches in front of your building. but that is depreciated. So over a period of time, just like the goodwill here, it drops. All right, every month it actually drops because most companies use standard depreciation. So every month they knock off a little bit. All right, so that explains the balance sheet. So now we go on the other side. So we know about current assets and current liabilities. We got A equals L plus OE. So for the liabilities, the most common one on there is accounts payable and accrued liabilities. All right, ones that you're paying for that haven't occurred yet. So in this case, I actually did some common sizing for you. In 2009, they had $17 million in accounts payable. The next year, they had $27 million. All right, so is that a big increase? Well, if you subtract the 17 from this, it was $9 million one. And that comes out to an increase of 50.8% is what their payables went up. So again, think about what I'm trying to figure out with this company. All right, whether I'm going to sell to them, maybe I'm going to buy them, work with them, or loan them money. Their payables went up 50% in 1 year. If we look at everything else, their inventory went up, their property, plant, equipment went up, and now their AP. So as much as that may be scary that it increased, you can look at it two ways. Are they not paying their bills? And you'll be able to find that out because we'll be able to do a ratio and called DPO to determine just how fast they're paying their bills. Okay, just kind of the opposite of DSO. And for right now, what we don't know is how much they actually have out there, because them getting credit and having the creditors feel comfortable enough to lend them that and give them that is a positive sign. Right? You may say, well, look how much it grew. Are they not paying their bills? Again, you can figure that out. But to me, the other positive is that the customers they're buying from have enough confidence in them to allow them to have an extra $10 million. Next, you got income tax payable. This is all due again within a year. So they had $615. This year they only have $44. Then they've got a deferred gain on the sale of equipment. Okay, so they're going to have to recognize that later on. And then they have a capital lease obligation. And notice how after these it says C Note 6. When you look at these, those are both kind of unusual items to have. So you'd have to flip down to the notes and understand, what it was. They're more than likely like one-time occurrences. Okay, so that was your current. Now your long-term, again, that Note 6 has got to be pretty lengthy. Deferred gain on sale of equipment. So again, all right, 285 is deferred. Capital lease obligation, obviously $2.5 million. It's going to expand more than 1 year. Long-term lease inducement, 140. And future income tax. So somehow they've been able to defer it, which for cash flow purposes is great because they don't owe it now. They're going to end up paying it later on. All right. So again, we remembered how much their assets went up. Remember, they were $57 million in 2009, and they jumped to $70 million. But we also see that their debt jumped up. Now, what's left? Remember, A equals L plus OE, or in this case, shareholders' equity. They have shares of stock out there, and the first thing they show is that their common stock went down a little. Okay, they had $40 million. Now it's down to 39. Actually, they must have bought some shares back because they had less shares outstanding. They had 56 million in 2009 down to 55. contributed surplus, that is the amount of money people paid over the actual par value of the stock. Okay, so they obviously made out there a little bit as we're about 400,000 higher. Now they've got accumulated other comprehensive loss. And again, that's a special note. So they must have lost money either on selling something that they had on the books as one, but they took a loss. Without looking at the note, we wouldn't know. And then they had a deficit in both years. So that is everything. And at the end of the day, A, right, we go back to A. Let's take 70 million plus equals L, right, which is 34 plus OE. At the end of the day, we tie out, and that's basically how you look at your balance sheet. But remember, the best way to do it is to common size. Like over here, you could put, 50.8% increase. Obviously, this was a huge decrease. There's nothing to compare here because they had nothing over here. But that's one of the ways you can break down to see how the company is operating and if they're keeping things under control from one year to the next. So there's your balance sheet. All right, we are going to go to the income statement. Now, this is the granddaddy of them all. Everybody wants to know, did we make money or sales up? So in 2009, this company had 139 million, and they jumped to 153. Now, this is the tricky part. If you look at it over here, it shows their sales jumped $13 million in 1 year. What's the growth on that? Well, it's 9.5%. 13 million to against 139,870. The question is, were those quality sales, or did they buy somebody, or did they just raise prices? So the way you look at that, if they truly sold more widgets, okay, without a huge price increase, did they sell more widgets than they did the year before? If they did, then that's a good thing. Now, if they just had a big price increase, and instead of selling 1 million widgets, they sold 975,000, but their sales went up, it's because they had a price increase. It wasn't necessarily quality sales growth. And of course, the last piece is, did they go out and acquire another company? Of course, if you go out and buy another company and you include their sales with what you had the previous year, of course it's going to go up. So those are all things you need to know and figure out. And again, the notes will tell you that. All right, now comes some of the fun stuff. So when you have those sales, okay, it depends on what kind of company you are. So this was obviously a manufacturing company in the real numbers, but I turned it into a sporting goods company. But let's first, learning purposes, assume this is a manufacturing company. Manufacturing company has a cost of sales, or we call it here cost of goods sold. You might hear it in the office called COGS. In 2009, 97,000 of the 139, or 69.4%. And obviously you take the 97 divided by the 139. What that's saying is that $97,000 in manufacturing, whether it was paying the people to make the product, the raw materials that went in, the power, the electricity, everything it took to make those products that were eventually sold go into that number. So when you take that number away, all right, they have 42,861,000 left. And if you notice the percentages, because I did common size on this, that number is the inverse of the one above it. And the two of them together will always equal 100%. So here you've got 69.4, 30.6. The next year, this jumped to 71.4. This jumped to 28.6. It's always going to equal 100, and the gross profit is the inverse of the cost of goods sold. So after you figured out the cost of everything, you're going to have the gross profit left. Now, another thing I wanted to point out, this is simple. It just says sales. You may see some where it says gross sales minus sales and returns maybe minus discounts, and then it'll say net sales. And then it'll be the net sales against the COGS. Here they don't make that difficult. They just have a pure sales number. All right, so now you've got 30.6% left, or $42 million, to pay off all your other expenses that are not related to the direct sale of the product. So one of the things that you have to do is you have to advertise. So they spent $18 million in advertising in 2009, and they dropped a little bit in 2010. Now, all the people that kind of probably do what we do that are on the call, if you're working in accounting, FP&A, any of those other fields, those salaries all go here because you really have nothing to do with the manufacturing or making of a product. Sometimes people even think of accounting as overhead, right? And then, of course, you've got amortization, which every year, remember, amortization and depreciation go against the value of the machinery, building, or whatever, and that value drops. It's not any different than if you bought a new car on the lot for $35,000 today, and then you try to return it in December. You'll be lucky to get $28,000 for it because it depreciated, right? So it knocks the value down, and every company has to do that. Now, they got some share-based compensation that they had to pay out, which is basically probably bonuses. Then they got interest expense. So obviously they had to borrow some money. Okay, now in this case it says income or expense. Maybe they actually had some people borrow, maybe the president borrowed money and for his own use, and he's paying it back. All right, or in this case, they had 67 as a minus. They had to pay interest out on something. Then the following year, they made money, so they had to come from interest income. Now you got foreign exchange gain and loss. So this is an international company. You know, in the last couple of years, our dollar in the U.S. has been extremely strong. So what's killing companies that are multinational is their other divisions are really weak against the dollar. So when you look at those foreign exchange rates, you've got to lower it down because all those other subsidiaries and companies that you have. And then last, they've got listing costs, which honestly for this one, I don't remember the exact what this company did, but they didn't have them in 10, so that was just another cost. All right, when we bring all this down, remember you had $42 million left. All right, these equal $38,864. That number's 27.8% of that. It left you with $3,997, or 2.9%. is what's left. Now remember, you started with sales, plus cost of goods sold, you got gross profit, then here's all your other expenses, and you got this left. You then have to take out income tax expense. So this year they had to pay $1.2 million, and then they must have had another payment that they needed, okay? And or that was a future recovery, I'm sorry, they got back. So at the end of the day, their net earnings were 2,747, or 2%. Now, the other piece of this that I want to show you is many of you hear your company talk about EBIT, because everybody's got to pay taxes. But how much did you get before you had to pay income taxes? So that's your earning before interest and taxes. Okay, so that's your EBIT. Now, if we compare the 2 years, the one thing that jumps out is that they had an increase of 2% in their cost of goods sold. So you can think, for example, let's say during the oil crisis, anything that was an oil-based product, the price went up, you know, during that time. So if this company, for example, was doing anything with oil-based products, then whatever the raw materials they were buying definitely jumped in cost, and maybe that's why it went up. And as we read around sporting goods, you'll see what that increase was due to. So again, same thing, 71.4. What do we got left? We got 43 million left. Okay, here we had 42, but it's 2% less. Now, we go down, we notice they lowered advertising, but they may have added more people if they had another store, because it went up literally almost $3 million. And again, is $3 million a lot? Well, it's a fifth of 16, right? It'd be a little more than 3, right? So you're saying, it could easily be, what, 30%? Did it increase, right? 20%, I should say. Anyway, we saw that they paid more. Their share-based compensation was less. And obviously this was a variable because they had less margin to play with, so they didn't pay out as much, which was smart because that's their job is to, they still got to show profit. Let's see. I'm sorry, I read across incorrectly. The amortization went down. Share-based compensation, again, was less. So it went from this to this. They made money this year, so whatever happened during that year, the exchange was in their favor. Okay. So they ended up with $3,049,000. Ironically, this was 2% versus 2.9. So they made up, because remember, they were down 2% starting. They're only down 0.9 here. So that leads me to another point. You have a company who has to hit a certain number. Let's say they have to hit 3 million. But right off the bat, they know they lost 2%. So the only way they're going to make it up is in here, by cutting back. Either advertising, and this is where people get impacted, salaries. All right, so maybe the raises this year can't be 3 or 4%. They can only be 2 because they realize if they cut back 1% on all that, they can save maybe 1% that they lost up above. They can't really control the amortization. They definitely can control the share-based compensation, which they did do. They paid out less in bonuses. Interest expense, they were fortunate that they made money on their investments. In the foreign exchange, they were fortunate there because if both of these were negative, they may have had to cut more up here. And then again, the downside of it's really bad and sales are down, then you end up having layoffs and people getting, losing their jobs. All right, so here they made 2% this year. Then they had income tax expense current, that's what they had to pay, and then they had another recovery. At the end of the day, they had net earnings of 2, which ironically is the same as it was here. All right. Now, some of this here, you can dig deeper if you really wanted to know how the foreign exchange impacted it and so on. But right now, for our purposes, if you understood this, okay, and worked it all the way down, then we're in good shape. All right, now comes the interesting one. This consolidated statement of cash flows. In all my years of teaching, this is one of the hardest concepts to get. So get a drink of water, all right, come back and focus 100% on this because this is the one that's a little tricky. To do the cash statement, there are 2 methods. There's the direct and indirect. 80% of the people or companies that do this use the indirect method. Indirect method starts with your earnings, or in some cases, if you lost money. So that's your first number you start with. So I'm going to go with 10 because it'll help me tie in better at the end. So if you remember this 3102, right, where do we find that? We find that from the income statement. So there's your 3102, okay, and there's your 2747 from the year before. So 2747, 3102, and those are your earnings. Now, let's go back to the part about depreciation and amortization. Let's take that car that I talked about. So let's just say the company bought a car, and let's say that they paid $35,000 for it. It's going to depreciate. So the car is going to be an asset, which is going to be under your long-term assets, okay, under property, plant, equipment. And when you bought it for the $35,000, that was the value. But the fact of it is, it's going to depreciate a lot in that first year. So we're going to say it's going to depreciate $500 a month, or go down $6,000. So if at the end of the year you bought let's say you bought the car on January 1st, and it depreciated $500 a month. After 12 months, it's going to depreciate $6,000. So at the end of the year, if your year ended on 12/31, the book value on your balance sheet of that car is going to be $29,000. Okay? But did you really take money out from your assets for that? You lowered your A. Remember, that was part of your assets. The fact is, no, you didn't take cash out. But the fact is, the value declined. So what you have to do on the cash flow statement is add that back. So if you look at the amortization, 2272 and 2585, you will see those two numbers right here. That's what they reduced their assets by. Well, you really didn't take out cash every month, you just lowered the value. So you need to add that back for your amortization or depreciation. Same thing here. You had the deferral of the lease, you have to add it back. Now here they might have been over when they had to reverse it, but in most cases, you're going to add it back. Share-based compensation. What I'm believing this is that they issued stock for the people, so they haven't really cashed in yet. Okay, they reduced it as an expense, but cash wasn't taken out because they received stock. So by having the stock, again, cash didn't really switch hands. Now, future income taxes, they had to pay future income taxes. So because they had to pay it, on the cash flow statement, it's a use of cash. All these here are sources of cash. They're adding cash back that they took away for this and this. Now, stick with me. This is where it gets fun. Let's go back to the current assets on the balance sheet. Remember I said here receivables went up, and then we know inventory went up, and prepaids went up. Well, from a cash point of view, we'll do receivables and payables because those are the easiest to remember. Receivables went up from one year to the next by $979,000. Okay? Again, this number is the difference from this change to this year. Now, if your receivables went up, why did they go up? They went up because you weren't paid. If you had gotten the money and the cash came in-house, your balance would have dropped and you would have recognized the cash coming in. But because the balance went up, it is a use of cash, so you need to put in a negative. Okay? Had it gone down, what's the only reason receivables go down? Well, true, you could say credit memos, but generally it's because cash came in the door. Same thing for inventory. It's an asset that increased from one year to the next. So with the asset increasing, okay, inventory rose, okay, because you didn't sell it, but it's an asset that increased. Again, it's a minus. You now paid more in prepaid expenses than the year before. And that one's a simple one because you paid more than the prior year by 1.2. So there's actually like a cheat sheet that says if assets increase from one year to the next, it's a use of cash. If they go down, it's a source of cash. Okay? So use that as your cheat sheet. And if you can't remember that, remember the receivables, and now I'm going to tell you about payables. And I realize that this was a typo, so I apologize. Remember what payables did? Payables went from 17 to 27. They went up $9,104,000. Okay? So, why did payables go up? Payables went up from one year to the next because you did not pay them. You did not have an outlay of cash. So since you didn't lay out cash, okay, and you saved that money, this is a positive, okay? The mistake I've made is this should be the 9104. Okay, I apologize for that. So this should have went up. So this is a positive. Now, we then paid taxes. All right, again, paid taxes. But then you got a deferred gain on disposal of property. So you recognize the gain. You might have had a machinery that was depreciated to zero, but somebody else needed it, and they paid you $373,000 for it. That was a gain. So at the end of the day, this company, through their operations, remember, there's three parts to the cash flow statement. Through their operating activities of running the business, they generated $7.9 million. Obviously, the big two were income, not paying their payables, okay? And the year before, they didn't generate any, which is a concern. You know, if they had 2 or 3 years of this, then you'd wonder how they're ever going to make it. So again, this is one part of the cash flow statement. The second part is investing. Investing has mainly to do with property, plant, and equipment, whether they sold, depreciated, what happened. So in their investing activities this year, okay, they received payments from loans that they had out, and people paid them $169,000. What always is in the investing is what they have to pay out, in this case, acquisition of property, plant, and leasehold improvements. They bought these. So by buying them, they incurred debt, okay, which is a use of cash. So that's why this goes down $4 million. They acquired intangible assets. How did they acquire them? They bought them, which again is a use of cash. Now, for some reason, they had disposal of property, plant, and equipment of $3 million. Now, I don't know if we turn it around sporting goods. Maybe I had a smaller store and I was pulling out of the neighborhood, okay, and the value of the store had depreciated to zero. But now somebody says, hey, I want that store. And let's say we had it on the books as, you know, a value of $100,000. But they're going to pay me, you know, $3,511,000. Well, I just noticed a gain, and it is cash coming in. So in this exception, and again, we have to look at the note, they pulled in 3.4. So for the investing section, which is the second section used, they lost $877,000. Okay, so that's the second section. Remember, the first part of this is the operations, which I say is very important. This is the investing. Then lastly, we've got financing. So how did they make or lose money through financing? They issued common shares of stock, okay, and they brought in $146,000. But then, as we noticed, they canceled some of their own shares because remember their shares outstanding dropped? Well, they bought their own back, which usually when a company buys their own shares back, it's called treasury stock. So they brought it back. It cost them $158,000. They basically lost $12,000 here. So together they lost $889,000 and they made $79.03. Okay, taking the exchange rate, they had an increase in cash, an equivalence of $6,007,000. You go back to the beginning year where it was $11,532. $11,532 plus the 6.7 gets you the 18. So whenever you're trying to do the cash flow statement, here's the key. If this is cash and cash equivalents, and it happens to be on the same line, sometimes they may have cash, and then it might say cash equivalents or some stocks. You would have to add those two together and those two. And the difference between this and this is going to be your net amount. So again, they made it nice and easy for us. They started cash this much, they got this much, so you know it's got to be a positive number. So when you go all the way to the end, okay, that went up 6.7. So if you got that, all right, then congratulations, because that's a tough part. But again, you can go back and see this, and I'm giving you these numbers so you can tie back. Now, we talked about the notes. Immediately following the 4 financials in the section entitled Notes, the notes are an integral part of the statements that must be read in order to understand the presentation on the face of each financial statement. So the first note of the financials provides a summary of the firm's accounting policies. So you may look in and see their depreciation method. Is it FIFO or LIFO? If they changed it during the year, well, it's going to have to be noted. Because if you started with LIFO, which matched your most recent costs of product against earnings, then switch to FIFO, which would be what you paid earlier for the same products, you're going to make more money. You're going to show more money made only by changing the accounting method. Or if you change depreciation methods. All that's going to be in this section. Okay? And if there were any changes in any of the accounting policies, this would be explained. Now, some of the notes would pertain to the following topics: inventory, property, plant, and equipment, long-term debt. So let's say they did have to borrow because they have a new project coming on board, and they had to borrow money. Well, they'd want to know, all right, where did you borrow it? Do you have covenants that you have to, meet every quarter? What's the interest rate you're paying? That would all be in there. And lastly, any major acquisitions or divestitures that took place, officer, employee retirements, pension plans, lawsuit, stock option plans. Or maybe if you have a union and the union contract is due, next year, all right, what's your plan if the union would go on strike? All that stuff would be in your notes. So make sure that you take the time to read the notes. All right, auditor's report and opinions. This is related to the financial statement, and notes is the report of the independent auditor. So management has hired this auditing firm, and they have the responsibility for the preparation of the financials, including the notes, and the auditor report attests to the fairness of the presentation. So what they're looking at is you're going to tell the auditors, this is how we pay a bill. This is how we post cash. When checks come into the building, this is what we do. And this goes in all of finance, everything that they do. How do we set up a payable? Well, we find the PO, we match the invoice, we get the receiver, we make sure that the price on the invoice matches the price of the purchase order, we look at the quantity, and so on. They're going to now test everything that you said. If at the end of the day, the auditors feel that you're doing everything that you say you're doing, you're going to get an unqualified opinion. That's the best opinion you could get. The unqualified opinion states that the financial statements present fairly in all material respects the financial position, the results of operations, and the cash flows for the accounting period in conformity with GAAP. And basically those exact words are written. So if you're looking at a company and you read that, because it's not going to tell you we gave them an unqualified opinion, you're just going to see that, and that's what you're looking for. So again, that's the best one that you can expect to find with that verbiage. Now, let's just say that we had one faux pas where you maybe changed depreciation methods or you did something, and they're going to say, well, it didn't really change the outcome. You still had a good year. It changes it slightly, but we're not going to really slap your hand for it because it's not that big a deal. They will say that, in our opinion, except for, their changing of depreciation methods, the financial statements fairly present, blah, 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 blah. So you'll see that word accept, and that's still okay. Now, if there are numerous accounts in financial relationships that are not within GAAP, then they're going to give you an adverse. And if you see an adverse, I would run as fast as you can, because these people are obviously have poor accountants, or they're really trying to hide something and, not run the business the way it should. Then there's a disclaimer where they cannot evaluate the fairness of the financials and express no opinion, and a limited scope is they're not willing to share enough. So the auditors haven't done enough to really give it an opinion. But right now, don't worry. Look to have a qualified or an unqualified, which I think most of them would be. Okay? So this is for your reading later. Again, this is kind of what I touched upon. It just kind of go a little more in depth than maybe we need to go. Going back, okay, auditor's reports and opinion. Arthur Andersen. Now think about this, guys. It's just crazy to me. Enron paid them $52 million in 2000. $25 million for work audit, and the remaining for other work, including consulting. So you pay Arthur Andersen $52 million to help run your business and then audit it, and then you end up going bankrupt. So the court did not take this lightly. Arthur Andersen was ordered to stop auditing publicly traded companies after the firm was convicted of obstructing justice during a federal investigation of Enron. So when I got out of school, there were basically 4 major accounting firms, and Arthur Andersen was one of them. And then all of a sudden, boom, they're knocked out and have never been able to do it again. So I thought that was a pretty harsh fine, but well-deserved. All right, so kind of set you all up for this. Let's look at the audited financials for Ron's Sporting Goods. So what I literally plugged in here was Ron's Sporting Goods in place of the company. Remember, it's a Canadian company. And even though it's a Canadian company, here's what it says. In our opinion, these consolidated financial statements present fairly in all material respects the financial position of the company as of October 31st and 9th, and the results of its operations and its cash flows for the years then ended in accordance with Canadian generally accepted accounting. So they got an unqualified opinion, which is start to something good. So I'm feeling comfortable right off just reading the opinion. Okay? Now, there's also a piece called the management and discussion. Remember I told you earlier that the audit is basically looking at how you performed. But overall, the analysts want to know where they can expect to find things such as the internal, external sources of liquidity. You're going to run this new machine. Where are you going to get the money to pay for it? You've committed to paying these bills. Where are you going to get the money? Are you going to have to borrow? Or what are you going to do? And then sometimes they also want to see the breakdown of sales into price and volume. Remember I said earlier, is it quality sales? Is the business really doing better? Or did the sales go up because they bought somebody or they raised the price? And sometimes in most companies you have an array of products that you're selling. And some are marked higher than others. So you could sell, let's say, 100,000 widgets in a month. And let's say, you make $1 million. The next month you only sell 88,000, but you make 1,200,000. Well, wait, you sold less widgets. Well, in the month that you sold less, you happen to sell your products with the highest margin. Okay? So obviously, those are the ones you want to sell all the time, but that mix showed that you had more, but it was due to the selling the right products. And of course, the inverse can happen. You can sell 10% more and make less money because you didn't sell the higher end. All right, each account has a 5-year summary. All right, when you look at this, you're going to see a 5-year summary for any 10K or 10Q. And obviously, if you just have, like we do here, have 2 years, that tells you a little thing about the 2 years, but a 5-year history is probably a lot more beneficial so you can see some trends. Remember, most companies in the United States, if they can make it into their 5th year, they've done well. Most companies fail in those first 5 years. So you're going to see the summary. The summary offers the user of the financials a quick look at some overall trends and allows for comparisons between years. So that's a good thing. Now, one of the other things I have to tell you to watch out for, I remember years ago I owned Disney stock. And when I got their annual report, it was kind of cool, because you're reading through there and it goes, oh, that's right. They did Lion King this year. They did Aladdin. And you're going through all the big movies that came out and all these things that Disney did. And you get caught up in that, thinking, wow, they must be doing great. Your average stockholder, I don't think, goes back unless their stock is really dropped and looks at the financials. So the financials may be so-so, but don't get caught up in the fluff that you read, because they'll really build it up like they're doing great when they could be losing money. So what are the objectives of analysis management? We look to the financial statement data to determine how well the firm has performed and why. What operating areas have contributed to success and which have not. You don't want to just look at what you're doing good at, look at what you're not doing well at. What strengths and weaknesses of the company's financial position, and what changes should be implemented to improve. So those are some of the objectives you want to find. Some of the ways we use, I taught you the common size financial. Okay, put everything over a percentage. If it's on the income statement, you do it over net sales. If it's on the balance sheet, you do it over total assets. We're going to talk about some ratios coming up. Trend analysis, okay, you're comparing businesses, compare how your business is doing to another. Same thing with industry comparisons. You're going to look to see what they're doing number-wise. And then the thing that I really can't always teach is common sense and judgment. Talked about common sizing. So in case, you have to look back, there it is. Now, ratios. There's mainly 5 categories of ratios. There's liquidity ratios. Those show you how much debt a company has, and also how liquid are they. How fast can they get money and turn it around. Activity ratios from the sales generated, what are they doing with that? Let's look at those ratios. Leverage ratios is your debt. How much debt do they have? If a company's got twice as much debt as earnings, okay, that may not be bad because you're growing. If you don't have any debt, then it means you're probably not growing. But, if that leverage debt gets to 4 or 5% of the equity, then you may have problems. Profitability ratios, you want to look at your margins. Remember we talked earlier about the gross profit and cost of goods sold. Then you always have market ratios just to find out where you're trending in the marketplace, your company versus others. Now remember, ratios are a valuable analytic tool and they serve as a screening device, but they do not provide answers in and of themselves. So you can't look at a company and look at 2 ratios and go, oh my God, we're not going to sell them because their current ratio dropped, from 2 to 1.8. Okay, they're not predictive. Okay, just like flipping a coin. Just because heads came up 3 times in a row, it doesn't mean that it's going to be tails next. Or depending on how you look at it, that's going to be another head. Every one is independent of itself, like every coin flip. It's got nothing to do with what happened before. It should be used with other elements of financial analysis. So it's not one thing that you're looking at. You're tying over all those things we looked at initially. How much did they grow? How much did their expenses go? How much money did they make? All those things put together. All right, we'll start with liquidity, the firm's ability to meet cash as it arises. Now, when you look at the current assets, they're always in order of liquidity, with the top one being the most liquid, which is your cash. So you're going to see these ratios as we move on. You got the current ratio, which is current assets over current liabilities. The quick or also acid test ratio, which takes out inventory of the current ratio over the liabilities. We'll look at the cash flow ratio Average collection period, also known as DSO. Okay, days sales outstanding, how quick are you collecting? Days inventories held, how quick are you turning your inventory over? If you're a supermarket, you're going to be turning over a lot quicker than if you're Boeing and you're making airplanes, right? And your days payable, or we call it DPO. You can figure out how fast this company is paying their bills, because if your terms are 30 and they're paying in 90, you may have to have a talk with that controller or somebody before you start selling them, because why do you think they would pay you sooner than everybody else? So, if we look at Ron's Sporting Goods, here's their current ratio for both years. I also put what you need to do to get to the ratios. Current assets over current liabilities. All right, 2 to 1. They had twice as many assets as they did liabilities. Here it dropped a little bit, but again, thinking used to be 20 years ago, you were close to 2. Now it's probably closer to 1.5 because you're going to have more debt because you want to grow. So that's going to knock that down a little. And here it is, it's current assets. You take the inventory away, which remember that's your biggest asset on your balance sheet. Okay, so those are those. There's your day sales outstanding. So Ron's is doing well because think about it, they're a grocery store, or I'm sorry, a sporting goods store. They're getting paid in 20 to 21 days between the 2 years, which is great. Now, their days payable going from 67 to 90. So I'm wondering what's going on there, right? We need to dig in, look at the notes. But that's how you accumulate it. So for your DSO, you take an average ARs, whatever 2 months you're doing, or comparing, you can do it 12 months, whatever, over your sales, average daily sales. So you take whatever your sales are, divide by 365, you get a daily average into the average AR. Payables is your payables at the end of any month over your total cost of goods sold divided by 365, and that's how you get your DPO. Now, I threw this out there because the one thing that I don't want any of you people in credit or credit managers to do is ever have your performance rated by DSO, because DSO is mainly driven by sales. And this is the example that I used. It's a real-life example from one of the companies I worked at. And if you look at it all the way through and look at the explanation, you'll see. So briefly, what happened is, in the month of January, the company had shipments of $53 million and their AR balance went to $62 million. In that month, they collected 98.2% of everything they could, which if you look here, this was the highest month they ever had in history. Okay? But look what happened. Their DSO went up 6 days. And the reason it did is the way they do the formula, they take the last 3 months of sales, okay, and do the average, and they average it here by, let's see, 30 days, 31, and 31. 92 days into this number to get your average daily sales. And then they would take this number plus this number for your average AR. But when you compare it to the month before, here you had 53, all right? You jumped 6 million, okay? But look at here, you had 31 and 27. The 2 lowest months of the year with this one dropped that denominator. So you got a denominator that gets smaller, and you got a receivable that gets bigger. It went up 6 days, but you collected the most you've ever collected. Do not allow your manager to rate you solely on the DSO. Make sure that it's some kind of collection percentage, how much under 60 days, all right? All right, leverage ratios. Leverage ratios measure the extent of a firm's financing with debt relative to its equity. Can they cover that, and can they cover the interest? So one of the first ratios is debt to equity, all right? Or in this case, total liabilities to total assets. How much debt do they have? You know, can they cover it? Profitability. We already talked about the gross profit. We'll talk about the other ones, and you'll see them on the sheet. We got net profit, cash flow, return on investment. You've all heard of that. return on equity, and cash return on assets, right? Depending on what company, some may need more, some may need less, but I'll show you my template. Profitability, the first one we showed. Remember your sales and your gross profit, right? You can take your sales less your COGS, they give you your gross profit because the cost of goods sold and the gross profit together equal the net sales. Now, one other thing we talked about, you may hear your company talk about, is free cash flow. Free cash flow is the cash from operations. Now, remember on the cash flow statement, we had operations, investing, and financing. You take the number for that time period and you take out any capital purchases. So anything major that was bought, the amount left over is your free cash flow. Okay? Now, one of the coolest things I think is this Altman Z-score. Dr. Altman went to UCLA and back in, I think, the late 70s, developed this. And what this is going to tell you is that the company you're looking at is potentially bound for bankruptcy. So I have the template, and if you need the template, you can email me. I'll give you my email address at the end. You pop in all these things: total assets, working capital, bing, 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 bing. It's going to calculate your score. If that score is greater than 2.99, there's very little chance at all that this company's going to go bankrupt in the next 12 months. If it falls in this range, there's a zone saying, well, there might be, at least watch out. If it's 1.81 or less, this company's going bankrupt. So it's always a good thing to add on. And here it is. I did it for Ron's. I put in the assets, working capital, retained earnings. And when I asked for market value, I did the same thing. Okay. It came out to 4.80 in 2009. And it came out to 4.02. So Ron's is really doing well. No worries about him going under. Now what I did was, this is one of the templates I could send you. It's got Ron's Sporting Goods. It's got the year of the statement. And it's got their sales from this year to last. And it's got the current ratio, which is current assets over current liabilities, debt to equity, and I put exactly what you need so you can do a comparison. And your boss can look at this and see, what you've done. All right, so they're getting paid in 20 and 21 days. They're paying in 67. Here's your sales, your gross profit, operating expenses, net income. So they made money both years. Popped in the Altman Z-score and the auditor's opinion. Okay? And then down here we can put what their past credit limit was and what you want the new one to be. And I always do a history. All right? So for the sake of time, you can read this, but it tells all about the history. Maybe talk to the salesperson, understand what this company is, what they're made up of. So this company started in British Columbia. They're one of the largest online sporting goods stores. 11 years later, they had sales of $100 million in merchandise. Okay. They raised $6 million when they went public in 2004, and they expanded into the UK and Europe. All right. We put all this in here. All right. They went ahead and introduced overnight shipping on all products in response to customer feedback, and as a result, they saw a 41% sales increase in the U.S. They provide top-end athletic wear that they purchase from Nike, Adidas, Eastbay. In March of 2011, they expanded the designer wear to include plus sizes for women and had signed a contract with Liz Claiborne for the next 5 years. They also gave some charity work, blah, blah, blah. So now you know a little bit about it, and then here comes the final one. This is my summary and conclusion. So in 2009, they started with 139 million Canadian dollars, increased 9.5 to hit 153. Their cost of goods did jump, and this could have been contributed to the new import tax the U.S. implemented in 2010. So that would tell you why it went up 2%, because they had to pay that much more to get their product into the U.S., which is one of their biggest markets. All right, even though they did have a cost of goods sold increase, they did the right move by reducing expenses. So they reduced their expenses 1.2, even though their margin that they lost was 2. So they're only going to lose 0.8. They generated cash flow in 10 where they didn't in 9. All the other things that I calculated, and then I summarize. All right, overall, we see that R&S had a 9.5 increase in sales. They generated cash, lowered operating expenses, and showed a 2% profit. Their debt's under control, working capital increased, they easily passed the Altman Z-score, and there does not appear to be any chance of them filing for bankruptcy in the near future. Overall, they are very sound. Then maybe you could suggest a credit limit.